I mean, if you're brand new to the channel, if you're brand new to Matt, what he's doing, the whole VIP team, I just want to say he's legit. The information is real. It works. So just wanted to
Thank you. Hey everybody, Matthew Pillmore here. Welcome back to the VIP Financial Ed YouTube channel. I'm the president of VIP Financial Education, and we help you go further, faster financially. We do it through teaching unique ways of banking. I call it the 3 C's of banking and borrowing. This is your credit, capital acquisition, and cash flow maximization. So we've got a very special guest and topic today for this episode. This is a good friend of mine, Mr. Kevin Amolsch. Kevin is the founder of a company called Pine Financial Group out of Denver, Colorado, and one of the most well-known, arguably one of the most successful hard money lending operations here in Denver, as well as in Minneapolis, Minnesota. So we're gonna be talking with him throughout the day about how you can acquire real estate with little to no money out of your own pocket. If this is your first time on the channel, again, welcome. Thank you so much for tuning in. If you have not yet done so, I encourage you to consider subscribing to the channel and make sure you turn on the bell notification in order to get alerted every time that we come out with some new videos.
Thank you for having me on this channel with you today and doing this video. You know, you have lots of choices of people that you could bring in here, and I know you're looking for the absolute best. So I'm just humbled, and I want to share my gratitude to be part of this.
It's very important to pick who you do business with very carefully, because no matter how good you are at taking care of people and delivering on what you say you will, people can make it look bad. As you've started to see last week, this week, before, and into the future, we're gonna be talking about, it's often about who you know. And we shared that as well with our close friend, Christian Baker, who's actually sitting here. See, say hi, Christian.
Hello.
But I want you to get to know Kevin. I want to bring him on additional videos moving forward. The content that they teach is second to none. They're one of the only hard money lenders that I've learned of that are actually out educating. Seriously, having brushed shoulders with tons of organizations in this space, I have not found any that are doing what Kevin is to bring the community together and educate. I think hard money kind of comes with one of those skeptical first impressions too. So for those of you that aren't yet using hard money, I got to ask you why. Why is that? And usually it's a misconception about the price.
It's too expensive.
That's right. Exactly. So we're going to talk a little bit about that, because leverage is one of those things where Kevin's going to prove one of the single most important points I've made in our trainings, which is that high interest rate debt weapons can cost very little in the way of interest costs when it's paid off in a short amount of time. So high interest rates paid off in a very short period of time can cost substantially less than very low interest rates paid off in a very long period of time. What were your beginnings like?
So I was in the Army right out of high school. I couldn't stand school when I got out of high school, so I decided to go into the military. And I used that to my advantage. I took full advantage of the GI Bill, and then I went into the National Guard, and so I was getting my school paid for. In fact, the Army was paying me to go to school. It was awesome. Went ahead and bought my first house. I was 21 years old, barely made it. I was trying to get it before I turned 21, but the closing got extended. So it was the same month of my 21st birthday. And
that's awesome.
You know, I was in love with real estate right out of the gate. I was making money without working. I moved out of it and rented it, and I just saw that, you know, this is how I was going to get rich. Real estate is the vehicle I was going to use. So I got a student loan, and I didn't need it. I got the student loan to, what do you think I did with that, Matt? With that leverage, what did I do?
I'm assuming you used it as some sort of a down payment.
Down payment on my second house.
Debt weapon.
I mean, it was
my
creative
student
mindset loan debt weapon got me
Genius.
my second house. And then, like I said, I fell in love with real estate, so I started focusing on that. I started buying 1 or 2 houses every single month, and I did that for years and years and years. Then I got into the financing side because I love the deal structure more than managing projects and tenants and all that, although I do have a lot of rentals. I like putting the deal together, and that's what the financing is. So I started focusing on that. You know, I started getting a lot of people asking me, how did you do it? You're a broke college kid, and you're out there buying 1 or 2 houses a month. So I ended up writing a book years ago called The 45-Day Investor, and just last year I decided to publish it, put it on Amazon. And that goes through 2 different ways to buy properties with little or no money down. One of them we're talking about today. The other one's a much more complicated structure, and you don't need credit or anything for that. So I published that. It's 45dayinvestor.com.
We'll put that in the link we'll put in the description below. Guys, phenomenal read and really, really great reviews on this book.
$8.
It's $8, guys. If you can't go out there and enhance your knowledge with something like this, you know, it's going to be a much slower road for you.
And then I started doing classes and different events and writing articles, and that's kind of what led me into more and more success with Pine Financial, and then Pine Financial grew. You know, I'm teaching people how to make money and how to get rich, and I'm providing the money to do it. It just was a good fit.
I love that. Tell us a little bit about what your kind of game plan is moving forward. You're an investor yourself now,
Yeah.
not full-time, obviously, still running Pine Financial Group, but what does leveraging into these more passive and kind of residual income streams mean to you? Obviously, it's not your game plan to sit behind a desk for the rest of your life. You're looking for ways of earning even while you're sleeping, traveling, volunteering, spending time with the daughters.
Exactly what we're going to be talking about today. I've got lots of different types of assets. Real estate's obviously the primary asset, and the reason that is because it produces the most cash flow, and you could get into it with leverage using debt weapons and do it without very much money to get going.
Yeah, and in some cases not anything out of your own pocket, which is what Christian has been doing for a long, long time. And you've seen some of the videos that we've been releasing. It's funny that you talk about your VA loan getting into your first property, because Christian on the way over here was talking about people really trying to think out of the box, or even using a student loan to get into your second property.
Right.
These are the creative ways that people like Kevin or like Christian, ways that I've personally managed to create more wealth and streams of income for myself, is by thinking a little bit less conventionally and certainly less conservatively. You cannot be afraid to take these steps and step out of you know, your comfort zone and out of the box, or you're just never going to create any level of extraordinary wealth. So let's dive into it. What do we have for the listeners
Well, we're going to be
today?
talking about how to buy properties with little or no money down, and it's going to be cash flowing properties with equity, and that's what we're going to be talking about today. But first I want to explain what hard money is. So when I get a really ugly house like this one up here, I'll say, how do you finance this, or would you finance this? And
That thing is hideous. Look at that thing.
The answer is almost always no.
No, right?
And the reason they can't finance this is
Because it looks like it's going to blow up, right?
it's not, what's the word?
fall down.
It's a tough word to say.
Uninhabitable.
Habitability.
Uninhabitable.
Yeah,
Yeah,
the
yeah,
habitability.
habitability is the
If
problem.
it's not habitable, it can't be, it's not really bankable, we call it. So you can't go get a conventional Fannie Mae, Freddie Mac type of loan if you can't live in it.
That's right.
So the first reason, and the most important reason people use hard money or private money, would be if the house needs a lot of work. The second one is going to be if you need to close extremely fast. I mean, you were a mortgage broker for a long time. I was as well. Things are getting tougher now than even when you and I were doing it. But how long do you think it takes to close a property once you put an offer in with a conventional financing?
It's safe to bet on a 30 to 45 day
Yeah, 30
window.
to 45 days, and it closes every single time, right?
It's foolproof. There's absolutely nothing that goes wrong when it comes to financing real estate.
And if you're in real estate, you know this is true. If you go in the MLS, you take it off the MLS because it goes under contract and that thing falls through, you go back in the MLS, you just lost value in your property.
That's right.
So you're taking some risk by taking an offer that has a 45-day close. So less risk, shorter closing. You as a buyer can go out there and make offers and close extremely fast with hard money. We just rolled out this new loan. It's a 90% of acquisition, and we'll close you in a day or two. We don't need an appraisal or anything. So we're just closing extremely fast. It's
Interesting.
like 2 points in origination, and it's a done deal.
Oh, wow. Okay. Great.
So if you need to close fast, that'd be the second reason to use hard money. The third, and probably the final, maybe the most important reason is high leverage. You could do 100%
More deals
of-
with less money, right?
Yeah, more deals. That's where I was getting at. If you're not putting money out of your pocket into the deal, you're using the debt weapon, then you don't need, obviously you want the money in the pocket, so you don't need to use it for the deal. You could do more deals, make more money, build up a bigger portfolio, and that's what we love to do, and that's why I get so excited about it.
Yeah, no,
I
that's
want lots
exactly
of
right.
income, lots of multiple streams.
If you're consuming all of your resources, all of your liquidity on fewer deals, that translates to less cash flow each month, less potential, less opportunity. So the more capital that you can keep and hold on to and spread out over more and more opportunities, obviously the more net cash flow and freedom,
That's right.
residually, passively.
And then you
can
use
have.
some of your strategies that you've taught so well, and I've started to implement in some cases, where you start paying off the mortgages. Now you have more houses with no debt. Now we're talking about a pretty nice lifestyle.
That's right. The key here is trying to position yourself. We want to be ready. We want to be able to take advantage of the market the way it is today, which is scorching hot, but we also want to be prepared for that next transition into really an economy that's going to look a lot, hopefully, the way that it did back in 2009, 10, 11, 12. I mean, it would be great to be able to go back in time and take advantage of that. I can't wait for the next downturn. I don't know about you two, but I think it's going to leave a lot of opportunity for everybody.
If you could start doing deals and structuring deals now, when the market turns, you'll be prime and ready to just hammer it.
Great. So less money out of your own pocket is really important. So let's talk a little bit about the process and how does somebody actually get involved and take advantage of the hard money lending debt weapon option.
Okay. There's an 8-step process in this, man. You and I have talked about this a lot.
We have.
The first step, you got to be safe, you guys. The very first thing you want to do is go ahead and get pre-qualified. And if you're working with a good hard money lender that will do 100% of the acquisition and rehab, they're going to want you to be approved for a takeout loan. So what they're going to ask you to do is go to your favorite mortgage banker or mortgage broker and get pre-approved for what we call a rate and term refinance. And once you got that pre-approval, you're going to be pre-approved for the hard money. So step number 1, go get your pre-approval.
And the reason that you're doing this is obviously to see why your own A, right?
Because for me as a lender,
exactly,
I want to reduce my
as
risk.
a lender,
Absolutely.
You have to make sure that you're covered so that when you, the borrower, goes out, borrows money through a company like Kevin's and purchases your own investment property, after the work has been completed and a new after repair value has been established, you can then go out and refinance, therefore getting Kevin and Pine Financial Group paid back in the timeline established when the first loan was cut. So at the end of the day, he's got to make sure that you're a qualified borrower. This is where things like FICO credit scoring qualifications are so important. Being a lendable borrower is critical. So if you feel like there's work that can be done, and this is across all platforms of lender worthiness, borrowing strength, this is not just FICO scores, but debt to income ratios, liquid reserves, availability, just to make sure that when 6 months passes and you're ready to go back into the bank and say, hey, okay, I'm ready for that loan you pre-qualified me for, everything looks as optimized as it can. You're going to want to make sure you get not just an evaluation session from us, but Kevin is actually going to be offering something here by the end of today's lesson as well. So make sure you stick around to the end of the training here because we've got a couple gifts coming from this guy. But make sure you do get your free coaching session from VIP. We've got to make sure that you're the lendable borrower you want to be so that you can work with somebody like Kevin on that pre-approval process. So once they're pre-approved and they've got basically a letter for you, a pre-qualification letter saying, hey, you're qualified for the refinance that's going to replace the hard money loan that you've given them. Tell us a little bit about the 7 other steps.
All right, the next step number 2, you got to go out and find a good property. But I want to say a couple of keys, and I'm going to say keys a lot because there are several keys that make this whole process work. Okay. But one of them is you got to be in the right neighborhood. What we're looking for here typically is a 1% ratio. So I like to have my properties rent for 1% of the purchase price.
Okay.
Well, not purchase price. I'm talking about the all-in cost, purchase and repairs.
Okay. So if I'm spending $150 to buy
1%.
it, I'm spending $50,000 to fix it up. I've got a $200,000 all in. I'm looking at renting that for $20,000.
$2,000 a month.
Oh, $2,000 monthly.
Month.
Okay.
Yep. So
okay. I was thinking
1%
10% annually. Okay. So $2,000 per month.
And that's pretty attainable. I know here in the Denver market it's not so bad because the rents are so dang high. Other parts of the country can be a little bit more challenging, but typically what you're going to find is the lower income neighborhoods is where you're going to need to be for this process to work.
We do give away a rental investment property analysis worksheet from Joe Massey, really great mortgage professional here in the Denver area that we all know. And he's created a terrific spreadsheet. You guys can see that in our Real Estate Investing 101 training that I taught with Charles Roberts. So check that training out and you can get your copy of that investment analysis spreadsheet. But this is a really easy rule of thumb.
It's good. And
yeah, you can use it right out of the gate without carrying around your computer to check out properties.
So here's how you should focus on this. You want to look at retail value first and then do 1% per month for retail. And then in that neighborhood, when you locate the right neighborhood, then you go out and you try to find your discount property. But
Okay.
you want to be looking in the right neighborhood.
And this applies whether you're in a bull market like now or whether you're in a downturn market, right? I mean, this is something you can use in any economic condition.
Right.
It's just harder to find now because we're dealing with a lower inventory, right? And there's a lot more competition. So there's a lot of investors that are coming in with a lot more money than maybe you have today, right? Because if you're just getting started and you're saying, I really want to be in real estate, I just don't have all of the resources I want. Other people have them, and they come in and they swoop this stuff up. They sometimes even overspend to do it, right? They don't necessarily, just because they have money doesn't mean they know what they're doing. So then some of us that actually take the time to analyze the deals the right way can be left trying to find deals. It's tough. It's tough to find deals right now. So just keep in mind, this is a great way to start passing on things quickly. So the next step, once we've kind of on the surface said this seemingly matches what I'm looking for, that's when we go into the next step, which is really starting to analyze the deal. How does that fit with respect to the budget and cash flow and everything else you're trying to do through strategies that you're learning on channels like this and others? How do you make this work for your longer term game plans, whether those include accelerating the acquisition of more assets or accelerating the elimination of your debts? So tell us a little bit about that step.
Yeah, the next step is to actually you locate the property, and then you got to get the property under contract and do your diligence.
So you're making offers, you're getting it under contract, and you're making sure that everything fits the budget.
And it's not uncommon to have 30, 40, maybe more in this market offers to get one deal. So don't be discouraged. Just keep writing offers, keep trying, keep making them, get on all the wholesalers distribution lists, and
the easiest way to do that, guys, is to attend your RIAs. Just like we said in the previous video, attend groups like the one that Kevin has and get to know people who market to lists. And once you can get on a variety of lists, then you start to see properties that aren't even necessarily on the public market. They're not necessarily listed on the MLS. Sometimes they go to groups like this, or even smaller handfuls of people that are active. I know with you, Christian, you've had first access to a lot of properties that never hit the market just because of who you knew. And that's really important. Surrounding yourself with investor-specific real estate agents, surrounding yourself with investor-specific mortgage professionals, totally different than surrounding yourself with retail agents and retail mortgage professionals. So making sure that those are part of your team is incredibly important. Okay.
All right, so the under contract, there's a few bits here that we need to make sure that your viewers understand. And one of those is you are using hard money for this to work. It's not cash. So if you're writing a cash offer, there's a good chance that deal doesn't close. And here's why I think it's important for you to understand this. Hard money lenders, like any other lender, is going to want title insurance, and it's called a lender's title policy. And that ensures the deed of trust, the positioning of the deed of trust on the property. Without lender title insurance, a lender's not going to want a loan on it. Title companies are forced to or required to follow what the contract says between you and the seller. So if you're writing a cash offer, they cannot offer lender title insurance in a lot of cases. And I've seen deals fall apart. So here's how you do it right. First of all, you should probably just be transparent and say you're going to get a hard money loan and disclose that right on the contract. If you don't do that and you want to write cash, that's fine, but you got to put in the additional provision section something like this. It should say, buyer has the right to change to financing as long as it does not impact the seller's net. So that's what I would use.
And it doesn't affect the timeline. Obviously, the contractual timeline remains the same. So as long as it doesn't affect the buyer's net,
doesn't affect their net, so they're not going to balk at it. And then a title company is able to offer the title insurance, and so that deal will close.
But like you said, you're able to put cash as the form of financing. So obviously, far more appealing to the seller because they know that, right. But it stands out. Usually it's going to be more appealing, I would think.
I would think so.
Okay.
Do a short closing with cash offer, usually more appealing, like we talked about before. And then the second thing I want to make sure that your listeners or viewers understand is you want to protect your earnest money. So I would either do one of two things: not put earnest money down at all, which is very, very common if you're working directly with sellers and not through real estate agents. So no earnest money, or you got to write in your offers a contingency to inspect the property. And I would say 7 to 10 days. Give yourself enough time to put your budget together. Your hard money lender is going to want your rehab budget, so they know what you're going to do to the project, and so they know how to properly value it.
Okay. And you use the inspection deadline on the contract as that kind of window, a buffer period to be able to put the budget together. Plus, it's the last time that you can usually pull out of a deal and and still get your earnest money back. Now, you've probably had to pay for the inspection at this point in order for that to happen. Would that be a fair statement?
If you're doing an inspection. You know, I would recommend probably doing an inspection in your first few deals, but most of the investors that we work with, frankly, they don't do an inspection.
Interesting.
They're remodeling the house. They're going to put new stuff in anyway.
Okay. So they now have the loan, right? That's going to be the next step in the 8 steps, is actually acquiring that hard money loan. Okay. And then the fun begins, right? This is actually when the repair work and all that fun stuff
Yeah,
starts
go
to
out
happen.
and close a hard money loan. Your hard money lender, whether it's Pine or anybody else, they're going to walk you right through the process and exactly what to do to get that loan closed. Go to closing, sign the documents. If you're working with Pine Financial and you're in Minnesota or Colorado, we're going to give you a repair draw check at closing, so you'll actually leave closing with money to get you started on your project.
See, that's the thing you guys have to understand. When they say 90% of acquisition and 90% of the repairs, they're giving you money to do the vast majority of the costs of
Well, that
fix-up.
90% loan, to clarify, is a different product. That's if you need to close in a day or two.
Okay.
If the rehab loan, it's 100% of your purchase, 100% of your repairs,
Wow.
up to 70% of the value.
Interesting. So up to 70% of the after repair
repaired
value.
value.
Okay. So we'll get into some of those case study numbers for you guys to just show you how little you can get into properties and real estate investing from your own pocket, or even using debt weapons for that matter. So let's go ahead and keep moving forward on these 8 steps.
So then you got to repair the property, and that's, we wouldn't need to spend a lot of time on that. It's hiring the right contractors, managing the contractor process, and getting the property fixed up and get it so you could hit that ARV that we're talking about. Okay, after you get the repair done, then you got to go find yourself a tenant. You got to get the cash flow coming in. So for me, I like to use leasing agents. I'm busy. Actually, I'm really not that busy. I don't work that hard anymore, but I don't want to work that hard. So I like to hire people to do things that they're better at it, and my time is more valuable to me than what I could pay for. So a leasing agent is a great example of that. It's usually about half a month's rent is what the going rate is in town here. I think that's somewhat common nationally. And then they can get you a tenant, and then you can manage it yourself, or you could hire them to continue to manage it, however you want to do that. But it's get the tenants the next step.
Okay, so we've got our tenants. We now need to actually get you repaid, right?
Yep.
I mean, we can't just continue to hang on to these higher interest rate loans for any longer than necessary.
No,
we
you
want to
get
try
out
and
of
get them
this
paid
loan
back
as
quickly.
quickly as possible. So obviously the next step is to get the hard money lender paid back, and you should be able to do this fairly quickly. With Fannie Mae, there's no guideline to title seasoning. So the title seasoning guideline you might often hear is you got to own the property for this amount of time, and then you can refinance with Fannie Mae. What you're hearing there is called a lender overlay.
Okay.
So an overlay, to be as simplest terms, is you got to think that these lenders don't make money servicing loans. They make money originating loans.
Okay.
So what they want to do, Matt, and you know this very well, and I'm sure you have taught your viewers this, but they want to originate a loan and sell it to Fannie Mae. Fannie Mae is the biggest buyer of loans out there. So Fannie Mae has this box, and you have to fit within this box for Fannie Mae to buy that loan. So what lenders do, like Wells Fargo, for example, they'll shrink that box just a little bit by putting more guidelines in place so that they can virtually guarantee Fannie Mae buying that loan. The last thing they want is to hold that loan on their books. So when you have additional underwriting guidelines on top of Fannie Mae guidelines, those are called overlays, and they're extremely common. The number one most common overlay is title seasoning, but it's important to understand that's an overlay. If you hear that, you need to go find another lender.
Makes perfect sense, actually. And this is where you see a lot of the niche underwriting happening. And I've never really heard it defined like that before. That's very, very interesting. I like that. So what is the final step of the 8? How do we finally kind of get this wrapped up? You've seen the borrower refinance, Pine Financial Group's been repaid, and they're obviously...
It's theirs, your house.
Your house, you start managing it,
So now you got to
right?
start managing the property, and you can do that by either hiring a property management company or managing it yourself. If this is your first go at it, your first rental property, I highly recommend you manage it yourself, because look, property managers need managing. And if you don't know how to manage the property, how are you going to manage the property manager when you do decide to turn everything over?
That's a really great piece of advice. You'll hear a lot of horror stories regarding property management companies, so definitely get your feet a little wet or your hands a little dirty on that one. I think that's a terrific piece of advice. So these are the 8 steps, guys. From here, You just wash, rinse, and repeat the process. Go out there, get your pre-approval letter, and start over again. Get ready to buy that next property. If you haven't done so yet already, like I said, consider subscribing to the channel. We talk about topics like this all the time, and whether or not you want to be involved in real estate investing doesn't much matter. Ultimately, this boils down to how do you leverage other people's money and put it to work for you and turn your debt into wealth. That's ultimately what this channel will represent. So smash that subscribe button. Make sure you turn on the notification bell so that you're alerted every time new videos are released. We release new videos every single week. We also have a new contest going this month. We'll talk a little bit about that in our future videos throughout the week. So make sure you stay plugged in, like the videos, stay commenting, share them with the people you love, and we'll see you on the next video.
Go on, make some money.
That's right. Until then, take care.